DeepSeek raises a simple question that has clobbered energy stocks tied to the AI boom. What if AI can run sophisticated models without using so much energy? Wall Street's consensus view has been that AI will consume ever-growing amounts of electricity because the chips involved are becoming increasingly powerful. Those projections have led to surges in the stocks of a variety of companies, from power plant owners to natural gas producers to manufacturers of transmission wires. All of these trades start to wound down since last Monday. The hardest hit included independent power producers Constellation Energy, Vistra, and Talen Energy. All three dropped more than 20% on Monday. The bull thesis on independent power producers and most integrated utilities is entirely dependent on data centers. In fact, 75% of electricity demand growth from 2030 to 2035 is premised on data center growth. The DeepSeek model is more energy and capital efficient, which calls into question the significant electric demand projections for the U.S. First blush, the sell-off looks like a buying opportunity. There has been no sign so far that tech companies are considering reducing their spending on AI data centers since DeepSeek appeared. Quite the contrary. Mark Zuckerberg said his company is building a data center that is so large it would cover a significant part of Manhattan. Morgan Stanley estimates that tech companies are still planning $650 billion in capital expenditures over the next 2 years, much of that for data centers. But even after the week's price drops, most of the power stocks aren't obvious bargains. On a longer time horizon, they have hardly dropped at all. They're all still up year to date and have doubled over the past year. Constellation trades at 20 times its expected 2025 EBITDA, the preferred valuation method for capital-intensive businesses like this. In the meantime, broader market is trading around 16 times its expected EBITDA. The energy sector as whole only trade at 7 times its expected EBITDA. Vistra and Talen trade at 13 and 11 times, respectively. Constellation is considered more valuable than its peers because it owns more nuclear power plants. And nuclear power is priced at a premium because it's considered clean and reliable. The power companies have made a few special deals to supply electricity to tech companies at above market rates. Constellation is even bringing back a nuclear reactor at 3 Mile Island in a deal with Microsoft, and the deal made significant premium. Dumoulin Smith's price target for Constellation, which is just below the current stock price, is premised on the likelihood that the company signs above-market deals for 75% of its nuclear power. But they're facing increasing competition from other power suppliers that want in on this gravy train. Chevron, GE Vernova, an investment firm Engine No. 1 said last week that they're planning to roll out custom-built power plants around the country starting in 2027 that will be designed to plug directly into data centers. Natural gas producers like EQT and Expand Energy and pipeline companies such as Williams Companies and Kinder Morgan fell in reaction to the DeepSeek news because they had been expected to benefit from data center demand. There's reason to believe they can bounce back. Jefferies projects that 14% of the incremental demand for natural gas from 2025 to 2030 is tied to data centers. But natural gas has other major drivers that should keep the group's results strong, even if the data center theme fades. Exporting liquefied natural gas accounts for 61% of the increased demand. Anyhow, DeepSeek's sell-off was a bit of an overreaction, particularly given that the data center demand lift wasn't expected to come in 2025 and 2026 anyway.